Diversifying your portfolio means investing in many different types of securities and assets so that your general return isn't too dependent on any one investment. A diversified portfolio is often recommended by financial experts because it lowers risk without giving up much in terms of profit. Hello everyone, and welcome to a brand new video on the channel. Today we are going to talk about the importance of diversifying your portfolio. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. What is diversification? Diversification means having a range of assets that perform differently over time, but not too much of any one investment or type. When it comes to investing in stocks, a diversified portfolio would have at least 20 to 30 stocks from many different businesses. But a diverse portfolio could also include bonds, funds, real estate, certificates of deposit, and even savings accounts. Each type of commodity does something different when the economy grows or shrinks, and each has a different chance of making or losing money. Stocks can give you the best gain over time, but they can change a lot in the short term. Bonds can offer more stable returns because they pay out a set amount, but the amount can change as interest rates go up and down. Funds tend to be diversified because they usually hold many different kinds of investments. However, a particular fund may only hold one type, like companies that make marketable goods. So, based on how it's managed, a fund could have a wide range of investments or only a few. Real estate can go up in value slowly over time, and it can also bring in money. But it can be expensive to maintain real estate and fees are high. The value of certificates of deposit and savings accounts won't change, but they will grow slowly based on the interest rate or other terms of the contract. As the value of some assets goes up, the value of other assets will stay the same or go down. Over time, the people who are in the lead may fall behind or vice versa. In other words, these assets don't have a lot in common with each other. This is a key reason why variety is a good idea. And with no commissions at the big online brokerages, it's easier and cheaper than ever to make sure your portfolio has a wide range of investments. How diversification benefits you. Diversification can help you as an investor in many ways, but one of the biggest is that it can increase your possible returns and make them more stable. By having a variety of assets with different returns, you can lower the risk of your portfolio as a whole so that no single investment can hurt you too much. Diversification makes your returns more stable because different investments perform differently at different times. While stocks go down, bonds may go up, and CDs may stay the same. By having different amounts of each asset, you get a weighted average of the returns from all of them, even though you won't get the crazy high returns from just one rocket. Ship stock, you also won't have to deal with its ups and downs. Diversification can lower risk, but it can't get rid of all of it. Diversification lowers the risk of having too much of one stock like Amazon stock. Like Amazon stock or stocks in general, compared to other investments. But it doesn't get rid of market risk, which is the risk of having that kind of asset in the first place. For example, diversification can limit how much your portfolio falls if some stocks go down, but it can't protect you if buyers decide they don't like stocks and punish the whole asset class. Diversification helps protect you from a problem at a specific company when you have investments that are sensitive to interest rates, like bonds. However, it won't protect you from the threat of rising rates in general. Even cash or investments like certificates of deposit or a high-yield savings account are at risk from inflation. Even though deposits are usually safe up to $250,000 per account, type in bank from loss of capital. So diversity works well for risk that is specific to an asset, but it can't protect against risk that is specific to the market. How to develop a diversification strategy. Now that there are low-cost mutual funds and exchange-traded funds, it's easy to put together a well-diversified strategy. Not only are these funds cheap, but many of them can now be traded for free through big brokerages. This makes it very easy to get into the game. Building a simple, diversified portfolio. A simple way to have a diverse portfolio is to buy a widely diversified index fund, like one based on the Standard & Poor's 500 index, which owns shares in hundreds of companies, but you'll probably also want some bonds in your portfolio to help keep it stable, which give you a fixed return, are also helpful. Lastly, money in a savings account can give you security and be used in case of an emergency. Stock diversification. Diversify your stock and bond interests if you want to go beyond this basic strategy. For example, you could add a fund that owns companies in emerging countries or international companies in general, since INCEP 500 fund doesn't own those. You could also choose a fund of small public companies, which is also not in the S&P 500. Fixed income diversification. For bonds, you could choose funds that have both short-term and medium-term bonds. This will give you exposure to both types of bonds and give you a higher return on the longer-dated bonds. For certificates of deposit, you can make a ladder that lets you see how interest rates change over time. Some financial advisors even suggest that their clients think about adding commodities like gold or silver to their portfolios to diversify even more beyond stocks and bonds. Lastly, no matter how you put together your portfolio, you want to include assets that do different things in different economic situations. Diversification doesn't happen if different funds own the same big stocks, because most of them will do the same thing over time. If all of this sounds like too much work, you can have a fund or a robo-advisor do it for you. As you get closer to a certain date in the future, usually your retirement date, a target date fund will move your money from higher return assets like stocks to lower risk assets like bonds. Diversification is a simple way to smooth out your results and maybe even increase them. You can also choose how diversified you want your portfolio to be. For example, you can have a simple portfolio with only stocks or a portfolio with assets that cover a wide range of risk and return. That's a wrap on the video. I hope you liked it. If you did, let me know by giving it a thumbs up and do not forget to subscribe. Thanks for watching. See you next time.